Welcome to AM Best Audio.
Welcome to the AM Best briefing on the cyber insurance market. Thanks for tuning in to what promises to be a very interesting hour coming at the perfect time. A word of warning though, there are multiple conferences that run multiple days to cover all aspects of cyber insurance. We have an hour, and we'll try to uncover as much of the iceberg as possible in today's discussion. You can be assured, though, that the experts that we have assembled here are extremely capable of addressing a broad spectrum of issues in depth. I want to thank them for their time and insights, and let me introduce them. We'll meet the panelists in a moment. We may mention the subject of financial strength ratings. A full explanation of our ratings can be found at ambest.com. And the opinions expressed by our guest panelists are theirs and do not necessarily reflect the opinions of AM Best. So, without further ado, here are the panelists. First, we have Chris Graham, Senior Industry Analyst and my colleague from AM Best. Chris has been following cyber closely over the last several years and is an integral part of the cyber team at AM Best. Thanks, Chris. Next, we're joined by Miguel Canals, Senior Vice President, Treaty Underwriter at Munich Re. Miguel, thank you so much for your time.
Thank you for having me.
And in our virtually, we have Christopher Mee, Senior Vice President at Aon. Chris, welcome to the show. Thank you. And Alex Tannenbaum, Director of Services at CyberCube, a cyber risk modeling firm. Thanks a lot to all the panelists. And last and the least, my name is Sridhar Manyam. I'm the Head of Industry Research at AM Best, and I'm delighted to facilitate the panel. So at AM Best, we strive to make our analysis relevant, timely, and forward-looking. In that spirit, a few years back, for example, we introduced innovation as a component in our rating analysis. And now, given the increasing relevance of cyber in the marketplace, we are the first and the only ratings agency to assign a formal market segment outlook to the cyber insurance market. Currently, our outlook on the cyber insurance market is stable. And I just wanted to go over some brief overview of why that stable outlook is there. So some of the positive signs that we've seen over the past several years is that given the increasing prevalence of cyber in the news, increasing ransomware attacks, there has been a greater demand and increasing take-up rates on cyber. And because of insurance companies' involvement in the overall cyber underwriting process, we are seeing improvements in cyber hygiene over the broad economy. And look at the expected profitability over the immediate long to short term, in the immediate term, short to medium term. We think cyber insurance is going to be reasonably profitable for insurers, especially given the history, the loss ratios in the 40s over the past couple of years. And we think despite all that's taking place, given the underwriting terms, limits, deductibles, so on and so forth, we expect profitability to continue over the short to medium term. And there have been tremendous improvements in underwriting practices and policy languages, especially improving the clarity. There's still ways to go in terms of making policy language more clear and less ambiguous, but we have taken a lot of strides. The market has taken a lot of strides, moving from clarifying what is affirmative cyber, what is covered, what is not covered, so on and so forth, and doing a lot of improvements in the policy language. And Miguel will discuss this a lot more in detail, but the reinsurance market in general has been pretty supportive, and in the past year we've seen a lot of involvement from the ILS markets as well, as Alex will mention when we continue the discussion, because of improvements in cyber risk modeling and increasing comfort in the use of cat bonds and such. So these are some of the positive signs we see, and of course, as rating analysts, we are skeptical. So there is bound to be countervailing factors to our positive factors. So we do think there is growing sophistication of attacks, especially using Gen AI, and the hackers and the perpetrators always seem to be one step ahead of the cyber insurers in terms of trying to exploit vulnerabilities in software and causing compromise to networks and other computer systems. Aggregation risks, of course, we just saw CrowdStrike, a classic example of aggregation risk. Just one small flaw in a software has the ability to paralyze flights. It has the ability to paralyze hospitals, a whole slew of systems, and the concept of diversification gets thrown out of the window given these kind of aggregation risk. Model risk. Alex might have a few words to say about this, but I mean, in terms of relative maturity of models, cyber risk is relatively new, and there's been, again, several strides that have taken forward in terms of improvements in modeling and stress scenarios, but they're not as mature as, let's say, a property cat model. And given the dynamic nature of the risk, we think these models will continue to evolve and will continue to keep up with the risk environment. And while reinsurance has been supportive, we do think there's heavy dependence on reinsurance, and we saw what happened in the property cat markets over the last couple of years, where insurance companies that have been dependent on reinsurance, when that reinsurance rug gets pulled away, then unfortunately the exposure becomes much larger. So there is a real heavy dependence on reinsurance, and as long as the markets are stable, this is good. But if there's any abrupt movements, then there might be a little bit more exposure on the primary insurers. So those are some of the factors that contribute to our stable outlook. And before I move on to other topics, I know that most of us have CrowdStrike on everyone's mind. The CrowdStrike software error, of course, caused computers running the code to fail. Flights were canceled, surgeries postponed. My kids had a new excuse to be off summer school and summer jobs. So lots of stuff took place. So cyber insurance has been in the news a lot lately. And suffice to say, the tectonic shift to e-commerce and the interconnectedness of systems was in full display last week. So I want to begin by asking the panelists' thoughts about CrowdStrike and their views. Maybe start with Alex. Alex, welcome.
Great, thanks. And it's a timely topic for us at CyberCube because we just put out a number predicting the losses, which is 400 million to 1.5 billion. Certainly a lot of uncertainty in that. I'm personally very curious about how the system failure coverage unfolds and the sublimits that are really there given the softer market. And it's something that here at CyberCube, and I think the industry at large will spend a lot of time learning from and doing some counterfactual analysis. That said, I think three things that we can look at today and some lessons learned that we're starting to take here at CyberCube. And the first one has to do with understanding technology dependency at a granular level, specifically for event response and reinsurers and insurers. Taking the market share approach might work sometimes when you're trying to do an overall loss estimate, but if you're trying as an insurer to understand your impact, it's really important to understand who's using what technology, so you can start getting some broad estimates for your particular portfolio. The second one really has to do with supply chain risk. It's something that here at CyberCube is probably one of the very cores of what we do, and it'll continue to be so. And there's really two ways to think about this. The first is first order of magnitude dependencies. So in this specific example, who's using CrowdStrike and who's using Windows, certain Windows operating systems, because those are the ones that seem to be potentially impacted. But there's actually a second order dependency that becomes quite complicated and could increase what we would call the blast radius or footprint quite dramatically. And those are the other key technologies that might also be using the impacted in this case, CrowdStrike and Microsoft operating systems. And if that's the case, then you can get a much broader impact of who's being attacked, and modeling that is certainly something that we're working on and contributed to some of the numbers that we're putting out. And then I think the third one is it really focuses on how important it is to have understanding of interdependencies. What are companies doing well? What are they not doing well? And what are they prepared for if you have multiple events or near events in a single day? So you could think there's a little Microsoft Azure impact and what could have happened if, in multiple events. And I think one thing that I'm just left with is that the companies that we've heard about, they're really important companies. They're always on technologies. They're doing a lot of things right, and they just got unlucky because in a way they're using the software that just had this little glitch. But this is also the type of security we want to see. We want to see, automatic patching for 0 days. So I'll pass it on to the panels, but exciting times in a kind of gloomy way, and we'll keep on learning the lessons learned.
Awesome. Thanks a lot, Alex. I wanted to bring Christopher Mee in the conversation. He works a lot with retail and, got great experience working with customers and insurers in the cyber insurance space. Chris, what are your thoughts on the CrowdStrike incident and lessons learned, in the short time frame so far?
Sure. It was certainly an interesting weekend. One of the primary responsibilities we have as cyber insurance brokers, working with our clients to help them prepare a submission into the market, describing in breadth and depth their investments into cyber resiliency. And it was really incredible over the weekend to see all of those plans that we discussed with underwriters and with our clients put into action so quickly, so these companies could attempt to continue operations as best they could, recover their systems as quickly and efficiently as possible. It's really been a powerful message related to the importance of planning and alignment of traditional business continuity plans with digital infrastructure. Focusing on prevention alone, not enough. You really have to think holistically about resilience and business continuity when you think about mitigating cyber exposures. Candidly, it's also led to the realization in some places of the presence of gaps in traditional P&C insurance lines that can potentially be filled by more specialized cyber insurance products. So, as you said, we're still in the short term here, and really when we're working with our clients, they're still reviewing the event and trying to determine the holistic impact and the financial consequence. I imagine that process continues in the short term.
Awesome. Miguel, as a reinsurance company working with insurers, are you seeing more in terms of your partnership? What are you hearing from insurance companies about CrowdStrike?
Thanks. From a reinsurance standpoint, we sit somewhere on top of the pyramid, so it's beneficial in a way that we have a broad view of the market. And over the last few days, we've seen a few estimates, being identified out there in the market, which range between, as CyberCube, as Alex was saying, within the low single-digit $1 billion, all the way up to high single-digit $1 billion. So there's a pretty wide range of estimates out there in the market. Obviously, I think it's too early to tell right now what actual losses are going to look like. I think it's going to take a little bit of time for to understand the actual losses, and the reasoning of that is because just of the sheer magnitude of this event. This event is actually being flagged as the largest IT outage in history by some sources online, and it affected, as we know, multiple industry sectors across the globe. And when we think about how different industry sectors can respond to this type of event, and also by the size of the company, not everyone can restore back to an operational standpoint as quickly as others. Some larger companies may have IT on staff that could help, or IT on staff that they could deploy very quickly after the event so that they can get back up and running. Another segment of the market, like SMEs, may not necessarily have that IT staff in place to get back up and running quick enough. So that disruption will. There's still a lot to learn from that. From a, in terms of lessons learned or things that perhaps not lessons learned because I think it's too early to tell, but things that I would be expecting to happen from this event, how the market is likely to react. I do feel like I wouldn't be surprised, depending on the size of the actual losses, if companies actually go back to recalibrate their pricing and and maybe add a little bit more rate depending if their portfolio got affected, depending on the size, right? So we may see additional rate coming into the market, and perhaps companies will also go back to their policy form and maybe review under the microscope a few of the terms that are currently out there. I think this event will definitely test things like a waiting period, right, which are typically within the 8 to 12 hour range. Some insurance companies may find that waiting period is appropriate for certain industry sectors, but may not be so appropriate for others. So there's a lot to be learned from this, and yeah, it's still developing.
All right. Thank you. That is interesting. Chris?
I think one thing we're looking at here is, right, this is to some extent the biggest fear in terms of aggregate risk, in that so many different industry sectors get hit, and so many different geographic sectors get hit at once. When we think of catastrophic losses, usually you think of property, and hurricane's usually the first one that comes to mind, and that's kind of that's a narrow geographic area. Earthquake can be a little bit more because you have the possibility of, say, an earthquake in Japan causing a tsunami in Alaska, or vice versa, right? So the geographic area exposed to an earthquake could be a little bit bigger. I think of cyber almost like an earthquake on steroids as far as how fast it can spread, and across all different sectors. There's no geographic boundary. There's no political boundary blocking anything blocking any cyber risks from spreading. And I think that's part of what we saw here. What happens? I think to some extent, pricing will come into play here again. When you look at 1.5 billion loss on what's industry wide, less than about $7 billion right now.
U.S. premium.
Well, right, U.S. premium. That's going to be that's 20 points. Now again, U.S., but what's even worldwide? What are we talking? Maybe 15 billion in premium. It's 10 points on the loss ratio right there for the industry. So.
Interesting. So we'll have to wait and watch how the losses develop, and then maybe the industry will react as the losses come through. So maybe with that, Chris, would you give an overview of the state of the cyber insurance market report that was published before CrowdStrike?
Sure. So, all right. So this is what we're seeing in premium and loss ratio by year, and to your point, Trader, the loss ratio has been in the low to mid 40s the last couple years. Obviously we see the spike in 2020 and 2021. A lot of that was driven by the remote work environment and companies not having adequate security in place when it was forced, when remote work was forced upon them. It took a while for a lot of security measures to get put in place, and that's where we saw the big pricing response. You see the big jump in premium, driven by two things. One, all of a sudden there was certainly more demand, and two, some really heavy rate increases. 2021 and 2022, we saw on average 20+% rate increases each year, according to the Council of Insurance Agents and Brokers. So that's what we're seeing. It seems to have settled down. Now, beyond that, we also saw some of the other typical underwriting tools come into place. We did see an increase in retentions and less limit being offered, and I think that's what helped bring the loss ratios down a little bit. And I think it certainly helped with CrowdStrike as well. We've seen some estimates say that maybe only 25 to 30% of the losses are covered in the insured because of the self-insured retentions and what's below those. But we did see, after rapid growth, we saw, in the U.S. almost flat premium this year. This is going to be pretty interesting when we look at the top 20 insurers in a few minutes and break it down. There's a little bit of a bifurcation here in that the standalone premium shrunk and the packaged premium increased. And I think that's where you see, standalone cyber is mainly being sold to the larger entities who are going to have, who are probably more likely to feel the impact of these, of the self-insured retentions. And that's, when you increase the retention, you're going to see a decrease in premium. Whereas on the package policies, that's what your SMEs are buying for the most part, and that's where the demand increase is really coming from right now. I think there's starting to be a realization among even small Main Street operations that they need cyber insurance. You think of someone like your local pizzeria. If they have some type of computer system or where they you call and they know who you are if you've placed an order before, well, that's data that needs to be protected. So I think we're starting to see a lot more of that in a lot more of those type of entities buying coverage, and that's where the demand increase comes. Interesting that we see here is the surplus lines really starting to take over a majority of the premium in cyber. And this somewhat gets to the point that Miguel was just speaking about. When you look at the policy language, surplus lines carriers are in a premier position to tailor the language to the individual insured's needs. And with cyber needs being different for each company, it really does suit itself well for surplus lines coverage, and we're seeing that here. Now, top 20 insurers, there's not much change at the top. What is kind of interesting here, it's all over the map as far as the year-to-year change. We see double-digit decreases. We see double-digit increases. So, some people just saying we've had enough. Others saying, okay, maybe this is an opportunity to come in. And I think this is part of the aggregate risk management that we're seeing. And here you can see where we look at the total standalone versus the total package, that the package grew about 5%, even as the total PC industry was essentially flat. And now this is where we look at the estimated combined ratio too. We're estimating the underwriting expenses here by taking from the other liability claims made off the insurance expense exhibit for these groups. Probably cyber underwriting expenses are a little bit higher with all the front end analysis that goes into investigating possible threats, or I shouldn't say possible threats, but possible exposures, more so than on other lines of business. So the estimated combined ratio is probably a little bit higher, but you see that it has been quite profitable the last 2 years. Now, this is where you start looking at some of the estimates for the CrowdStrike losses. If we go with the 10 points that we just discussed, 1.5 billion on about 15 billion worldwide, now you're starting to look at a combined ratio into the mid-80s, maybe a little bit higher. But with that, another event could be problematic. So you maybe had enough margin for one catastrophic event. A second one would be, would certainly put a strain on profitability. The top writers by policies in force. Most of these are somewhat the same as what we saw last year. Obviously, a big increase from American Family, but more looking at the total industry. Even though premium was flat, this is where I said we still see the demand coming in as far as take-up rates. 11.5% increase in total policies in force. So there's certainly still a demand for cyber coverage out there. I said, I think you can expect to see even more coming forward now. Claims by policy type. Now there's a big jump in first-party claims this year. That's your ransomware, business email compromise type claims, and I suspect the CrowdStrike, it's going to be these claims are going to be more again first-party. The interesting part here is, as much as we've seen an increase in the ransomware claims, we're seeing a lot of the ransomware not being paid for a large reason. One, the increased cyber hygiene that we've talked about. Better cyber hygiene means backups are ready to go. Everyone's ready to get up faster. There's less of a need to pay the ransom to get the data back. And a secondary effect of that is, well, if I can get everything back, why pay the ransom to a criminal? If they stole the data, why do you have any belief they're going to destroy it and give everything back to you? So the better cyber hygiene has led to less ransom being paid, even though we're seeing an increase in claims. And that's the overview of the report.
All right. Thanks a lot. Chris, I would love to get you into the conversation and start with your thoughts on the abrupt declines in pricing and the prospective rate environment.
Sure. From my perspective, the decline in cyber insurance pricing, it's really been reasonable as a reset after what we view as an overcorrection by the markets in 2021 and 2022. Some of the things that I'll highlight really align with the data that we were just talking about in the market report. When we look at 18-ish months of consistent decreases across our client base, and with many of our clients seeing consecutive renewals with compounding decreases, even within that context, the base price per million for cyber insurance across Aon's client book of business significantly higher than it was in 2018 and 2019. And I think that that's probably true across the entire marketplace. You pair that with the fact that, again, highlighting what was just discussed, cyber resiliency across the board improves significantly. It's much more the exception now rather than the rule that companies do not have robust identity and access management programs or significant investments in backup policies and technologies, detailed incident response plans. All these things pair together, which of course mean that the likelihood of a cyber attack leading to a catastrophic event is lessened. Now, obviously, there's a number of high-profile cyber attacks that have occurred in the last year. But we're still really waiting to see how those translate into insured losses. And I think that is backed up by the data when we look at the loss ratios of the insurers that disclose them publicly being very, very favorable still. So, the rate environment may be leveling out a little bit, stabilizing more than it was, like I said, over the past 18 months. It's really not shifted back into a firmer marketplace. And until we see some of these really large catastrophic events translate into insured losses and payments, we don't expect to see a firmer marketplace come back into play, and particularly nothing like what we saw in 2021 or 2022.
Interesting. Yeah. Thank you. And Miguel, is that the same thing you're seeing when you're working with insurers?
Yes. I would say that, one of the questions that we ask ourselves, not only the reinsurance community, but the insurance community that we work with, is whether the cyber policy, the cyber product, is adequately priced. And as the report states, when we go back to the onset of COVID in early 2020, the industry had to react to that increase in the frequency of ransomware events, which led a progressive positive rate change on a quarterly basis, all the way up, peaking at as the report states, in the fourth quarter of 2021, which was, I think it was a positive 34%. Mm-hmm. And we've seen that positive rate change decelerate ever since, up to, I think, is the first quarter of this year, which was, correct me if I'm wrong, 0.4% for US data. So going back to the question, is this product adequately priced? Well, there is evidence of profitable loss ratios within the last few years. 2022 is shaping up to be a spectacular year, and 2023 is shaping up to be a profitable year as well. But one of the things that, from a reinsurance standpoint, that we highlight very often is the fact that the cyber product does not only contain first-party coverage elements. It contains a third-party component that, when we think about how losses can develop on a third-party basis, those losses take usually a lot longer to play out. It's not the typical first-party claim that within 12 months or 18 months you can adjust it and have a pretty good sense of where you stand. There is a real issue or a real concept, right? When we think about late loss development, it's something that's an issue with the policy or with the cyber products. Now, on top of that, within the last 12 months, we've also seen a flurry of widespread events entering the market. We can point to the MOVEit incident, Change Healthcare, CDK, Ascension, and the global IT outage on Friday. Now, maybe those events individually don't have the strength to knock the industry out, but they pile up. And we hadn't really seen a frequency of widespread events happening so quickly, consecutively, one after the other. And that's why I'm mentioning this, because it's important to monitor rates and keep in mind that this product is systemic in nature and that there's also a third-party component to it. So, is the pricing appropriate? Mm-hmm. To be determined. We'll have to wait and see how it pans out.
Good. Good answer. And you mentioned an interesting point that the rate is a function of the threat environment, right? So, Alex, maybe I can bring you in the conversation in terms of how are you seeing the evolution of threat vectors, because you model all these events. If you could, talk to us, that'll be great.
Yeah, happy to. And I think just to touch on the last point, and which will lead into this point, is those rate increases that were mentioned over the last two or 3 years. Clearly, that wasn't sustainable. So that really moves into, from CyberCube's perspective, what that means from a modeling perspective, what that means from a threat intelligence perspective, and what that means from evaluating risk. So what do we see in the threat landscape? Here at CyberCube, when we think of the kind of extreme tail, one of those events that might knock out the industry but will cause double or triple digit loss ratios, we certainly hone in on two specific types of events. So one is the operating system outage, which you could think of the CrowdOut is one example there, but you can think if there was a ransomware component, if it was more malicious or self-propagating malware, we see something that it could spread and really hit a much larger percentage of companies in portfolios, and therefore have more outage time as well. And then the second one is just any cloud outage, cloud malicious events there. But that's like if you look at the industry as a whole and the tail, I think one thing that we've really spent a lot of time on is thinking about specific industries. And this gets into diversification, which I'm sure we'll jump into. But really, what's that concentration risk for some of our high exposure industries, those technologies that a lot of people have never heard of, but are completely important to whether it's healthcare or banking or financials or any other high exposed industries as well. And really trying to figure out what's the potential there and what type of technologies could really cause that cascading outage.
Awesome. And from what you're saying, I'm also hearing because of this dynamic risk environment, there's a dynamic pricing involved, and there could be a wide distribution of prices around the average as opposed to one single price point. So, Chris, I wanted to get you into the picture because wanted to ask you interesting take on how has the purchasing attitudes of cyber insurance changed with customers over the past, say, 5 years since you've been following the industry?
Sure.
Go ahead.
Yeah, it's really interesting working with organizations as they review their own exposures on a regular basis. So many of them realizing that the value of their intangible assets
is really radically increasing in comparison to their tangible assets. And that's been true across all industries. Traditional purchasers of cyber insurance 5 or more years ago really siloed in spaces like healthcare, retail, financial institutions, technology service and product providers. And that made a ton of sense because at the time, the cyber insurance product mostly focused on privacy-related exposures. But as that coverage for, especially on the first-party side, for types of business interruption losses has greatly expanded within the marketplace, we've just seen, you pair that with the fact that more companies are leveraging technology for efficiency. So many more organizations have found value in leveraging cyber insurance as a financial backstop as a part of the risk management program. And then, this is only further increased by the fact that, I mentioned this earlier, traditional lines of insurance continue to add exclusionary language that either narrows the scope or completely removes available coverage for certain types of cyber insurance losses. When companies look at in this context and they go through a business impact analysis exercise or something similar, it really shines a light on how their organization can be significantly impacted by a cyber attack from a financial perspective. You also look at these examples of large, sophisticated organizations. Robust cyber resiliency programs can still fall victim to these types of attacks. And it just makes it very, very clear, I think, for many companies that even when you have best-in-class cyber resiliency policies, procedures, and programs in place, the financial protection that insurance can provide, it has a valuable place in that holistic risk management program.
Awesome. Just following up on that, Chris, if I can put you on the spot, right? I mean, in terms of the maturity of the cyber insurance purchase, anecdotally, we've heard like property, for example, property insurance companies know exactly the risk management techniques, how much insurance to buy, how much to retain. Is cyber maturing enough so the clients know the kind of purchases, the kind of allocations that they need to make for cyber insurance?
It's that's a real challenge. It's certainly in the past it felt more like throwing a dart against the wall and hoping you bought the right amount of insurance to address your risks. But it's been fantastic to see companies leverage organizations, whether it be someone like CyberCube or others, to really go through that quantification exercise and try to put a real financial model together to actuarially certify what their exposure to financial losses resulting from a cyber event. That's become more and more the norm for organizations that are looking to either purchase for the first time or right-size their cyber insurance purchase. They know that they have this exposure, and they're now more willing to invest the time and the resources into actually determining the appropriate amount of insurance to purchase when it comes to their own risk tolerance and their actual exposures.
Very good. Miguel, maybe you can talk about this particular topic where we talk about the lack of penetration in cyber insurance, right? And how even now, I mean, we look at the profitability of the insurers, maybe it's because they're operating inside of a very constrained box. How are you working with insurers, partnering with them to expand that box, expand the underwriting, make it a little bit more comprehensive?
So I would spin that around a bit and say that I think insurers have actually been thinking outside the box now for a few years, especially as the cyber market slowly matures, as there's more awareness of cyber risk exposures. But there's evidence to back up that insurers are allocating a lot of resources into either investing in their own tools by either hiring folks and developing their own tools to improve their risk selection methodologies, for example, and connecting the dots with what Chris was saying earlier. We've seen, generally speaking, a higher degree of collaboration between insurance companies, between the underwriting team, the risk management team of the company, engaging with the insured in ways that we hadn't seen before. So now we're seeing that it's becoming more common ground for the CISO of the insured, right? Sitting down with the cybersecurity expert from the insurance company that liaises with the underwriting team in order to make sure that the exposures are adequately addressed, and with the intention of being able to underwrite that risk appropriately. So, I think, again, going full circle, insurance companies are thinking outside the box. I think that the penetration rate that we're talking about, which has been historically low, that's for sure. I think that's more that stems from perhaps a historical lack of awareness of the exposure to cyber risk, which is slowly but surely changing. It's like they say, never let a good crisis go to waste. The outage that's unfolding right now could very well lead a broader segment of the market, perhaps even in the SME space, to entertain the idea of buying a cyber policy because they are now more aware that they are exposed.
Interesting. And no briefing or webinar can be complete without the mention of Gen AI and AI. So, Alex, how is Gen AI helping cyber insurance, and how is it a challenge?
Yeah, discussing AI could take many days, but we'll try to be concise here. So I think AI is obviously at the top of mind of the industry and certainly at CyberCube, and it's a big topic. So I'll try to break it down into three components. The first one is, how does it impact the threat landscape that we see today? The second one, from CyberCube's perspective, and I think a lot of the reinsurers and insurers, is how does it impact our ability to model the risk? And then lastly, as an industry, how do we be good stewards of AI, and what would that look like? So starting with that first one, how does it impact the threat landscape? It's complicated, and if you went back 5 years ago, what people considered AI is now just considered kind of table stakes technology. So we've actually had AI in the threat landscape for quite a while. Where it gets complicated is that both attackers and defenders are using AI, right? And to be determined about how that exactly manifests itself, we've certainly tested ChatGPT and tricked it into writing a phishing email. It's quite easy. So you can imagine that it lowers the barriers to threat actors. But there's also systems in place to be a little bit more sophisticated for defenders. The second one is, how does it impact our ability to model the risks? So cyber is a enigma in a way. It creates more data than any other line of business, yet it's the data that's the most difficult to get and the most difficult to make sense of and organize. And AI is just a boon for that. We've used it from the very beginning here at CyberCube, but it's very valuable in taking all this unstructured data that cyber does and making sense of it and being able to do attribution and other things that are critical for our data sets. And then lastly, and I think this might be the most important, is like, what is a good steward of AI for the industry? We're certainly in the position that we don't want to create a black box. We don't want just to put it into some AI generative model and get some numbers and say that's what the machine said. We want it to be challengeable. We want to make sure that we're representing AI in a useful way and not getting ahead of where it can go. And I think it's really important for us as an industry to not get too far up above the hype, be honest where we're using AI, be honest where we're not using AI, and recognize some of that risks that come with it.
All right. And any follow-up thoughts, Miguel?
Sure. I believe that the industry is leveraging AI in a number of different ways. From an underwriting perspective, for example, deploying AI can help in the automation of collecting data, which ends up helping to speed some underwriting processes. So that's it's a way that the industry is using it. Another way that AI is currently being used by some companies is that it's being deployed on certain claims departments with the intention of streamlining some of the administrative processes that come with that part of the company and that part of the operation. And I would say that I'll quote a colleague of mine that says that AI will probably not replace people in the workforce, but people using AI within a company may replace people that are not using AI. However, some of the issues, right, that come with AI are what Alex was just mentioning, right? That attackers are leveraging AI to articulate emails that are more efficient in having victims click on a link, right? So from a phishing perspective, malicious actors are using AI. From a compliance standpoint, I think it's important to mention that, in fact, I'll use an example. There was a case brought against the New York Times. New York Times brought a case against OpenAI and Microsoft alleging copyright infringement because OpenAI was allegedly using New York Times' data in an unauthorized way. So I would envision that companies, future examples like that could happen if there aren't any, or a lack of compliance measurements in place at the company level. So those are a few tidbits of information.
Interesting. So maybe Christopher Me, with the talking about all the AI and machine learning, we have seen a lot of MGAs come into the market offering cyber, exploiting these AI and ML technologies. How has that changed the market and you working with clients?
Yes, particularly in the insurtech space, I think like a subset of MGAs, if you will, they're really seeking to differentiate themselves and drive a different type of value proposition. And they do that by pairing certain types of services along with an insurance offering. Things like proactive scanning, vulnerability management, and advice related to those vulnerabilities, seamless incident response support. Traditional insurance companies, they've always offered those types of services along with cyber insurance. It's, think of it as something similar to loss control on a property policy. But I think the MGA and insurtech space, they're really the ones to have done it in a way that they've had buy-in from policyholders. And it's almost created this concept of cyber insurance as a service. And many policyholders find that valuable as they're getting something out of their insurance policy that traditionally you buy an insurance policy hoping to never have to use it. And they're finding ways to get value out of a purchase on a regular basis from these services that are paired with the insurance offering. That's on top of course, MGAs just generally being an additional source of capacity in the market, helping drive competition. But certainly very interesting. And as those insurtechs leverage these AI tools for these proactive services and for their underwriting and things like that, there's an efficiency there that I think is opening the eyes of the cyber insurance industry at large, to try to drive them towards innovation. And in an industry that frankly is not known for innovation, insurance in general. So it's very helpful seeing them be successful at doing this. It'd be one thing if they dove in head first and none of them were profitable and there's been no uptake. It's been quite the opposite, particularly in the SME space. So we hope to see continued success there, as it's a differentiated product offering that can be of interest to different types of purchasing philosophies.
Oh, that's really encouraging to hear. I think that's consistent with what we are hearing in the market as well, in terms of MGAs and delegated authorities becoming a much more important part of the value chain, providing more services. So that's why AM Best introduced the performance assessment for these delegated authorities as well. And talking about partnerships, Miguel, how does the partnership between insurers and reinsurers look like? Quota shares still the preferred form of risk transfer, and how involved do reinsurers get with primary insurers as they form this partnership?
The reinsurance community approaches the cyber market with the intention of collaborating and forming long-term strategic partnerships with carrier partners, especially within this product line, which, as we have established, is so systemic in nature and it's ever evolving. There is a high degree of cooperation that needs to happen between these parties across all aspects of the business, including underwriting, claims handling, product innovation, modeling, etc. So what I'm hinting with this is that communication is a key part of that partnership. And as part of that communication, there is a lot of data sharing that goes along between these parties, with the intention of making sure that there is a mutual alignment of interest, right, as the portfolio grows in the long term. Now, Data sharing is, as I said, something it's critical, and that really just helps out both parties to understand what types of exposures are being subject to the program, the losses that are emerging, any other emerging trends that need to be addressed. From a reinsurance structure standpoint, as you well established, quota share structures have been prevalent in the market, and they have been so popular, historically speaking, for a number of reasons. But when you think about a quota share structure, it really does allow for a straightforward distribution of risk between the parties. So when we're thinking about how, from a transactional standpoint, it's a bit easier to manage. Another aspect of why they've been so popular is that on a quota share structure, both parties are sharing premiums and losses from the ground up. So that relationship really does incentivize both parties to be in it to win it, so to speak, and work together to, as I said earlier, to make sure that the portfolio is growing in a way that's sustainable and in the long run.
Awesome. Very good. And how are other structures evolving? Are you seeing a little bit more of the stop loss or XOL kind of structures coming up?
Absolutely. In addition to quota share structures, we've seen, historically speaking, aggregate stop loss structures that carriers typically purchase those in tandem with a quota share. Aggregate stop loss help insurers protect their net positions when the losses aggregate above a certain threshold. In terms of the demand for those structures, we've seen a relatively small number of new placements come into the market, but those have been offset by a few other carriers discontinuing the purchase of their aggregate stop loss program. So you could theoretically argue that the demand for aggregate stop loss is flat.
Okay.
However, as carriers grow more aware of the potential catastrophic exposure that they have been pivoting a bit more to entertaining and exploring event covers, where within those structures they have the opportunity to protect themselves against a very specific catastrophic scenario. No event cover looks the same, and that's because each carrier has their own view of risk, and arguably speaking, each carrier has or is worried somewhat differently on their portfolio. So those, as I said, don't look exactly the same. But it's interesting as those will continue to develop. It will be really important to have those event definitions as clear as possible to remove any ambiguity in the case that there's a catastrophic scenario. The carrier will want to make sure that what they are purchasing will respond in the case that that a loss happens.
That was very informative. Thank you. And Alex, I know that CyberCube has been involved with modeling some ILS transactions. How is does that reflect maturity of the market, or like in terms of obviously right now the amounts are still not that big in terms of the risk being transferred to ILS markets, but the fact that they are being transferred and they are becoming a significant part of the risk management process definitely speaks to an extra option for insurers and reinsurers. Can you talk a little bit about the modeling for these kind of ILS structures?
Yeah, absolutely. And just to set this, the numbers around what's happening with cyber ILS, last year in 2023, we saw the first 4 public bonds issued, a little over $400 million, and CyberCube was the primary in 3 and involved in all 4. So it's certainly a big step forward, and as you said, on a global perspective compared to all ILS, it's quite small, but a good start for the market. And I think this piggybacks off what Miguel said is number one thing that we need to understand for both parties that are both issuing the bond and also buying into the bond is what is an event. That's absolutely critical for them to know they'll be covered. And then the second is what's the likelihood that event occurs to trigger the bond, and how much could we expect to lose. So this is really good evidence that there are some in the investor community who are looking at this from probably a more numbers-driven perspective that are starting to get comfortable and want to start learning about the market. We as CyberCube, and I think others, have spent 2 to 3 years really educating the market on what is cyber, what is diversification within cyber, and how does the modeling work, whether it's similarities or different from NatCat. So we'll see where the market goes. Obviously, being in a soft market, that could or could not change the issuance in the next year or so. But certainly, we think it's a testament to the models going from something that's very interesting to something that people can actually make decisions on.
Awesome. Chris, lots of interesting discussions. Wanted to get your take on what's AM Best how is AM Best reacting to all these cyber market developments?
So we have this cyber questionnaire now that we're sending out to the top 60 cyber groups. The top when we had that chart up of the top 20, that covered about 75% of the total U.S. premium. So when you start looking at the top 60, it's gonna capture most of the cyber premium in the marketplace. So it is something that goes it's part of the regular rating process now, right? So we have we get into the risk appetite and the underwriting strategy. Now we talked about that. That's limits, retentions, what types of businesses are being insured, the reinsurance. Miguel mentioned it's still mostly pro rata, and I think it's still right now about 50% of cyber is reinsured. So who the reinsurers are is playing a part in this. We look at is it first party, third party, all involved. Most of it is still all involved. What is the company's loss ratio on cyber? How big of a are they in the cyber market, and how much of their business is cyber? So these are all things that we look at on the just like as a regular balance sheet. Is it the benefit is for some of the larger companies, it is a diversifying line in that you're not getting the same type of losses you would get on the GL or the property. Here's another line of business that they can write that diversifies their book. So for them, it certainly plays a role in the business profile. I think that's one of the biggest things we see.
All right. Yeah, I think the cyber questionnaire will give us some more information on an aggregate basis about the cyber market as well.
Absolutely.
Yeah. With that, I had a lot more questions in store for the panel. I mean, I think we still haven't really discussed the Public-Private Partnership Act and the war exclusions and stuff like that. But it's already that time when I have to. It's the end of the hour, and I have to go for closing thoughts from the panelists. So maybe I'll start with Christopher Mee. Chris?
Yeah, I would just leave us with sort of a holistic thought that I think the cyber insurance market remains it's continued to mature and be valuable to policyholders. Coverage remains broad, although very differentiated between insurer offerings. And that's one of the reasons why it's critical to work with a specialist broker to be able to ensure that you're tailoring your cyber insurance coverage to address your most critical needs.
Thank you, and thanks for your time. Miguel?
Some of what we have talked about today reminds me of the literary works of Miguel de Cervantes, so Don Quixote. I think some of us or all of us know Don Quixote while he was, or that part of the book when he's riding his horse through La Mancha and he sees from afar what he thinks are giants. So with absolute resolve, he marches on with his lance to attack the giants, only to have his lance tangled up with one of the windmill's blades, and he falls onto the floor, hits himself pretty hard, and figures out that he wasn't really marching against giants. Those were actually windmills. Now, I just want to say that I'm not hinting that the cyber market is delusional whatsoever, but I do feel like there is a lot of work that needs to be done, collectively speaking, in order to improve the line of sight to what's going on out there right now, and for us to have a better understanding of how future events may look like. So it's going to require work from the modeling firms, from insurers, from reinsurers. It's going to require all of us working together.
Awesome. after those quixotic comments, Chris?
So I think Miguel touched on this a little bit about the tail that's on this book. So we don't really know for sure. The one thing I always get worried about here, as far as the tail on this is, schools tend to be, have the least secure systems, right? Because they just don't have the budget for it, and I think that's where threat actors could really do a lot of damage. And an 8-year-old kid isn't going to find out until he applies for financial aid 10 years later that his ID was stolen, and could be that's a big part of the tail, I think, that you got to worry about.
Awesome. And last word to you, Alex.
We think cyber insurance is absolutely critical. Over 50% of cyber catastrophe risk we think is uninsured in the U.S. market, and it's a lot of these small businesses, these kids that are really the ones that are most vulnerable, that still have relatively low penetration rate. So we think as a collective insurance industry, modeling firm, reinsurers, brokers, it's really incumbent on us to understand the risk better and to continue to drive that adoption.
Awesome. With that, we'll call an end to the briefing. But before that, I want to thank all the panelists for their time and insights. Thanks a lot. Really enjoyed the discussion.
Thanks for having us.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.